Welcome to our presentation on the 10 myths of reverse mortgages. And I'd like to introduce my friend Kam. Known Kam for quite a few years now.
Quite a few years, yeah.
And yeah, thanks for showing up, everybody.
Yeah.
And Kam, maybe start with explaining what Auxilium means.
Sure, I'll just tell you a little bit about myself. So my name is Kam Brar. I own Auxilium Mortgage. I've been in the mortgage industry since 2008. We started our own place in 2011 with Auxilium. I've done almost $1 billion in mortgages now. So we funded a lot of mortgages and well over, 2,300 mortgage transactions. So been around a while. And the reality is that most people don't really understand reverse mortgages that much because it's a different component of the traditional mortgage market. So today we're going to talk about reverse mortgages. What are they? Who are they good for? And the top 10 myths that you hear a lot about them. Because as soon as you say the word reverse mortgage, it's almost as bad as saying politician. People run the other way. So we're going to kind of go through it and I'll just walk you through it. So what we'll do first is let's kind of have and you've got a little handout in front of you there. And we talk about what a reverse mortgage is, right? So what a reverse mortgage is, it basically allows homeowners that are at least 55 plus to convert part of their home equity into tax-free cash. That's really what it is, because for most people, the only way you're ever going to free up capital in your house is, well, one of two ways. You're either going to downsize, sell your house, take some of the cash out, or you're going to sell altogether. That's pretty much the limited ways you can do it, other than, of course, borrowing money. Now, when you borrow money, as the older you get, if you're on a fixed pension or something like that, the idea of having payments is not always so appealing as well. So that's where a reverse mortgage comes in. A reverse mortgage is very much like a traditional mortgage, except that you're not required to make monthly installments. That doesn't mean that interest isn't charged. It's just that you do not have to pay. So it's optional. You can choose to pay the interest or you can choose not to pay the interest. So it's really good for folks who may be looking to pull equity out, get some cash flow, but do it without having financial hardship. Because let's face it, a lot of people these days some of them are on pensions, they're on fixed pensions, then maybe they're getting a CPP, old age security, they might have a limited pension of some sort, right? And so for a lot of people, that's kind of a challenge. All right. Now, the other thing that is important also is as folks get closer to retirement, I'm seeing even like in the old days, it used to be that most people's goal was to be mortgage free. I don't see that as much in Canada anymore amongst Canadians. Being debt ridden seems to be a way of life. And going into retirement with a mortgage is nothing untowards. And so the nice thing with a reverse mortgage is it's an optional way to look at it and say, hey, I just don't want these payments. Could I do something different? Okay. So, like I said, no monthly payments, option to pay the interest if you want to. There's flexible withdrawals with lump sum mortgages. With reverse mortgages, you don't have to take all the money in one go. So you could have, let's say, a house worth 500 grand, and let's say you qualified for $200,000. And you said, you know what? Every quarter, I'd like to get $3,000, $4,000. It can be set up that way. It could be where I just want a lump sum up front and I don't want anything again. It can be done that way. So there's a lot of flexibility depending on how you choose to do it. Okay. Again, we talked about the win is it basically improves your cash flow without disrupting your lifestyle. One of the reasons some of the people consider it is they need in-home care. And in-home care, as we can appreciate, is not inexpensive. So it allows them to augment that cost, use the reverse mortgage to pay for care aids and people to come into their home, which allows you to stay in the neighborhood that maybe you spent 20, 30, 40 years in, or raised your kids in, or whatever. You may not be ready to just get out of it just yet. Okay? So what are some of the uses that people have for reverse mortgages? Well, they pay off existing debts or mortgages. So you can have a mortgage currently, and a reverse mortgage can be used to pay that out. So that's one. You might, like I said, covering healthcare, unexpected expenses, renovate and or age in place. So sometimes what happens is, of course, you can appreciate as people get older, maybe they need a wider hallway. They need a special kind of tub. They need different kinds of setup in their home. all those costs when you're retired are tough to cover, but a reverse mortgage can, allow you to access those funds. You might also want to consider helping family financially. It's a living inheritance. We always think of inheritance as when we pass away. However, it's a front-loaded inheritance that you could give family now. I mean, obviously you hear the tales all the time. Family members are struggling to buy a house of their own. Parents would love to help kids or grandkids get into a property. And usually the biggest hindrance isn't the down payment. A lot of people lack a down payment. The advantage of using a reverse mortgage to assist in that is A, you can now give the funds to your family member, but B, you're not having to make payments for it. So it allows that family member to give that early inheritance and not have the stress of how am I going to cover that cost for them. Right? So it's a unique way to do it. Simply enjoy a more comfortable retirement lifestyle. These days with inflation, everything being a fortune, some of the people I had a client I dealt with one time, and really honestly, like you hear those horror stories, she was living on cat food. Like there was no money, but she had a house worth $1.3 million. That's wonderful to have all that equity, but if you can't do anything, what's the advantage? Okay. Sometimes, like I said, we talked about early inheritance, helping family members buy a property of their own. Some of the folks actually will use that money to invest it. Now, you may get a crazy investment of some sort that's yielding great returns, which would then warrant you using a reverse mortgage to take those funds and buy that other investment. Some people like to do that. Again, everything comes with risk, so you'd have to double check it, but that's another way to use it. Sometimes, like we said, talk about basically sometimes people use it for surgery and stuff. I had a client I dealt with once. She had to get complete implants for her teeth, and it was almost like $60,000 worth of dental work, right? So it's not easy to come up with $60,000, but it was the difference between her enjoying her life for the rest of what was remaining or suffering. And why bother if you've got all this equity once again that's not doing anything?
Paid for a trip to Mexico.
I guess, yeah. And like I said, we talked about using it to invest in property. So now we always look at kind of like everything has upsides and downsides. So what are the upsides of a reverse mortgage? Well, they have what they call a no negative equity guarantee. So what that simply means is, let's say, for example, your house is worth $500,000 today, and you get a reverse mortgage for $300,000. You don't make payments, interest is accruing, and let's pretend 20 years from now you owe $500,000. But the real estate market's cratered, and your house is now worth $300,000. You owe the reverse mortgage company $500, it's worth $300. No problem. When you pass away, once the property's sold, the estate pays what they got for it, the shortfall the reverse mortgage company needs. Nobody expects you to come up with that difference.
Is that right?
Yeah. Yeah, so that no negative equity is huge. Now, real estate market, as you know here, generally doesn't do that, but you could get caught in a bad cycle where, let's say, you bought it high and in the period of where you pass away, something happens that's low. Anything can happen, but at least it's peace of mind. You never owe more than your home's value. So you may physically owe it, but you're not obligated to pay. Okay?
Wow.
No fixed repayment deadline. You can keep renewing and renewing and renewing. The only time you're ever expected to pay out a reverse mortgage in full is you sell the property, but you can port it to another property, or the last person now, both of you are in care homes, or both of you have passed away. So you could have one spouse still living, other spouse passed away, and the reverse mortgage stays. It doesn't get paid out until the last spouse passes away. So lots of flexibility. Clear and transparent costs, they're very clearly defined. Your credit score isn't relevant. I'm seeing even today more and more seniors who have credit issues, who have gone through bankruptcy or having delinquency of credit card arrears because they've helped their adult children, assist and help them get out of situations, which has led to them having to incur debt on their credit cards or their lines of credit, which they're now falling behind on. So that doesn't matter. Your credit is not relevant. Okay. Previous bankruptcy, consumer proposals, not an issue. So what are the downsides? Everything as we know in life comes with a downside. The biggest downside with a reverse mortgage, quite honestly, is that the rates are typically higher. That's it. If you compared it to a traditional mortgage versus a reverse mortgage, you're looking at somewhere between 1 to 1.5% higher rates. But that's for the advantage of having that payment flexibility. Interest accrues over time. That can be a disadvantage because your equity is slowly going to erode, unless, of course, the property values keep up. Okay. Your remaining home equity decreases. And again, there are lower cost options out there. So somebody could look at a home equity line of credit. That's another instrument that seniors sometimes turn to. The disadvantage with that is that the bank can call that at any time. If the property values drop, they can decrease the limit on it at any time. Whereas the reverse mortgage doesn't work that way. And with inflation, as values go up, if your interest that's accruing is accruing at a lesser rate than the appreciation of the property, they can increase the limit even further as time goes on. So.
And lines of equity also require monthly payments.
They do, but you can manage that in a smart way. What we do with some of our clients is, let's say they have a equity limit of 250 grand. They only need 50. We'll use the line of credit to keep making the payments with. So it's totally fine. There's ways to.
So as long as there's money coming in.
We can keep robbing Peter to pay Paul all the time. As long as Paul doesn't leave town. Okay, so that's the bottom line. So we can do those flexible things if we have to. Okay, so like I said, your biggest thing one has to ask themselves is, do I need that additional equity? Do I want that additional cash flow? That is the reasons why you would be doing that sort of an action. Okay, and like we said, if you look on the very last page, you can see kind of the advantages of each. Like I said, you can sell, you can downsize, you can look at a home equity line of credit. So you can look at the advantages, pros, cons of each. And really that's what it's going to come down to. If you're not overly concerned with the interest rate, the overall cost, but you're looking for something that's going to enhance your lifestyle, help you assist family, not have financial stress, it's the way to go. So those are kind of the basics. And then what we'll do is I'll take a look at the myths and stuff in a few minutes. But thoughts, questions?
I have a question.
Yeah.
So I'm wondering about the reverse mortgage. Does it fall under the same sort of rules as a mortgage that you can only access 80% of your?
It's actually less. So yeah, the reverse mortgage companies are much more conservative than that. You can typically, the max we kind of cap out is, depending on the lender, 55% of the value of the property.
Okay.
They always leave a large cushion in there, which makes sense, because guess what? They're on the hook if the values drop dramatically.
Exactly.
Right? They don't want to be stuck. They don't really want you to not have anything for your estate to leave forward. And the other thing is where the advance that you get on a reverse mortgage is determined primarily by your age. So yes, your property values, of course, determine the overall, but the older you get, the more you can get. So typically, if you're 55, you're usually going to wind up with about 40% loan to value, 40-ish, because again, you've got a lot of life still left. And the lender wants to make sure that that interest that's accruing and everything is sensible. However, if you're 85, now you're closer to that 55, 60% mark, because all things being equal, the likelihood of how long you're going to still stay is going to factor in.
And the expectation is that there's more equity in the property. The older people are, they have more.
It's not that. It's the fact that if you look at actuarial tables, their lifespan is going to be, like let's say for the average lifespan is 88. Let's use that as a number. You're 82. Well, the lender can advance more because in those 6 years, there's not going to be as much interest accrued. Equity still going to be left behind.
Okay.
Versus somebody who's, let's say, 55, if you advance them that 60% at the start, and let's say live another 30 years,
right.
There you go.
And
That's
then
why.
my other question is regarding the existing mortgage.
Yeah.
So if they don't use those funds to pay off that mortgage.
They have to.
Oh, they do
Yeah,
have to?
yeah. What happens is a reverse mortgage won't go behind an existing mortgage.
Yeah.
No lender likes to be behind another lender.
Okay.
So you will have to utilize it. So what we do when we meet with clients who are interested, first thing we do is to determine how much they can get.
Yeah.
Because if you can't get enough, then it's not going to make any sense.
Exactly.
Yeah.
Okay.
So that's the first step, right?
Right, so, because my other part of the question was like, then they would still have to be making payments
No.
on that mortgage,
No.
but if it's not there anymore,
No.
then that's
Yeah.
actually a benefit.
Yeah, so that they will use that mortgage to pay up your existing one, provided there's enough there, and any surplus goes to you.
Okay.
Yeah, so it solves that payment problem.
That's all. So what if you don't have a mortgage, but you have a HELOC?
Same thing. And people always people always have fancy acronyms. So a home equity line of credit is a mortgage. That's all it is. All it is it's an open mortgage that's readvanceable, which simply means that you can pay it off, pay it down, and readvance it. That's all. But it's the same thing. Yeah, and the advantage versus a reverse mortgage versus a HELOC is, let's say we are in a market which craters. The company, like typically under Canadian government rules, home equity lines of credit are capped at 65% of the value of your property. They cannot exceed that. So let's say you have $1 million house, you have a $650,000 line of credit. Market goes in the tank. Now that house is worth, let's say, 500 grand. Something insane happens. Well, that lender at 65% is way over. And the bank can call that. And they can say, hey, we want this paid down now. And you got to scramble then to find funds. And which would be a challenge because you'd be upside down because the property's not worth it. So therein lies the problems of when you're older. Now, the likelihood of that kind of a dramatic drop is very rare, but anything can happen. Yeah.
So if a person has a house that's say $1 million
Yeah.
and a mortgage at about 100,000
Mhm.
in her 80s,
Yeah.
she could apply and get like 500,000-600,000,
Potentially. Yeah.
would pay off the
Yeah.
existing mortgage.
Yeah.
And so the remainder of that,
Yeah.
does it operate a little bit like a HELOC? Like,
No.
So you're paying on
No,
all of that?
No, so you couple of things. What you can do in a situation like that. Yeah. Hi, come on in.
Hi, sorry I'm late,
That's okay.
but I'm late whenever.
That's okay.
So I'm thinking, if she could take the greatest, like apply for the greatest amount of mortgage that she has.
Yeah.
That she can get, and only necessarily want to use 100,000.
Mhm.
Is she paying interest on 100,000 or
Yes, only
on
on
600,000?
Only on 100.
Okay,
That's the nice thing with it. So what we can do is, that's why, like, if she only took 100 now, and let's say she said, hey, I want an extra 3,000 or 4,000 a month, every month augmented to my income.
Yeah.
As the balance keeps increasing, that's what you're paying interest on. That's it. So the beauty of that is taking the money all at once. And so let's just use simple math. Let's say you borrow 600 grand at 5%. That's 30,000 interest a year. If now I've only borrowed 100,000, that's only 5,000 interest per year. And as I'm advancing more, my payments, my interest cost is going to be minimal because I'm only increasing at a slower pace. So that's a great way to do it.
but she's got access to the rest
100%.
if she
Yeah.
needs it. She doesn't have
Once
to
the
use it.
global limit is set, it's set.
Okay,
She'll always have access to that much money. If suddenly an emergency hit and she said, I need $200,000, she can have it now.
so it's a little bit like a HELOC in that way.
In that way, except the advantage is that you're not required to make any payments. Nobody's going to reduce the limit if they look at it. So let's say you take a HELOC today, and in that period, you've never used it, but 5 years from now, the property values have dropped 30%. Well, the institution is going to reduce the limit.
Yeah. Okay.
Whereas here, they won't do that.
Okay, got it. Thank you.
Okay. Other question?
So I was just gonna say that these, this reverse mortgage, company, they're sort of, self-insuring themselves because they're betting that the market is gonna be higher in the future than lower, right? Because
Oh,
that's
yeah.
why they would say,
Yeah.
well, whatever, if the house was $500,000 and then, in 5 years later or whenever the loan was due, it was only 500, they're gonna eat that. I mean, that probably just never happens, so.
No, it happens in some parts. Like in Canada now, we have about 5 reverse mortgage companies. About a decade ago, we primarily had 1.
Yeah.
So it's grown a bit.
Yeah.
And the one that's been around forever, they're all across Canada. And the areas where they've had losses is places like the Maritimes. where values are either stagnant or they've dropped or whatever else. So that can happen, but we need a company to make money, because if they don't make money, they won't keep offering the product. So that's why they're conservative with the amount they advance.
Yeah.
They always leave room. And as you're younger, you get less. They're all the way around. They want to ensure that at worst case, they break even, like everything, they get all their interest back.
Right.
Yeah. So it's a pretty conservative way, but I mean, if you look at a market like Vancouver, Vancouver, Victoria, how crazy the growth has been, it stayed ahead of it. I mean, these guys run tables, they know what the average growth rates are, even factoring in cycles in the market. Generally, it bodes well that by the time everything's done, the estate will still have surplus cash left in it.
Right.
Yeah. Okay, does that answer some of those?
So does the interest rate remain the same throughout? So if you take $100,000.
Yeah.
And it's 5% when you start, but the interest rates go up and down over the next 10 years. Is that always what?
So there's a couple of different ones. There's one lender out in the marketplace that now guarantees the rate forever. So, you start a bit higher, but then they take the average, and I think currently their guaranteed rate is somewhere around 6%, but it's for the life of so you can be 20 years, which is a great opportunity. There's, most of them will do 5-year cycles, just like traditional banks. So they'll run the 5-year, and at the 5-year, you have the renewal, you have options. So same kind of way. So it'll all depend. We can look at it. Each one has its pros and cons. So sometimes people say, well, what if rates fall even further? Why would I pay higher now? It's buying insurance essentially. Okay. Yeah. But again, because you're not worried about making the payments, it doesn't really matter. I mean, yes, it'll eat up more of your equity, but you're not going to have the financial stress of having to make those payments.
So if the reverse mortgage companies aren't getting paid out until somebody dies.
Or
the
sells,
house
or
right?
yeah.
How are they managing to stay in business?
So-
Where does their money?
So
come from?
a lot of the companies are funded by large pension funds and different groups who have allocated their money. Think of it like a bond. You put your money up and you're locked it in for 10, 20 years. You're not expecting yields on an annual basis. You're getting it at the end of redemption. And they know the number of their people that by logistics, let's say I have, 20% at 55, 30% at 75. They know what the debt mortality rates are. So they're calculating all of that all the time. And they're all federally regulated. So it's not like you've got a bunch of cowboys in the street that are just kind of doing willy-nilly stuff and you may risk losing your house. It doesn't work that way. Okay. Yeah. Any other questions on that? Yeah.
Income tax and
We're gonna hit that in the midst, but I can go, so I'll make it very simple. So right now, when you sell your house, you don't pay any income tax if it's your principal residence for now, until the government decides they want more money. So for now, it's exempt. So is this money. When you pull this money out, it's tax-free. Yeah, you're basically treating it like, anytime you pull equity out of your property, it's tax-free. As long as it's your principal residence. Okay, yeah, so that's the nice part of it.
maybe that's your most category.
Yeah, I'll do that. And so we'll kind of look at those other things. Let's have a look here.
Got it. Listen,
Sorry?
my apologies.
Did you have an outburst?
Does that kind of help with clarifying some of that? Okay. So let's look at some of the most common myths. These are very much all the things I hear all the time. Okay, myth number 1, the lender takes ownership of your home. People believe a reverse mortgage, the lender owns your house in some way. It's not. It's like any other mortgage that's out there. You retain ownership of your home, they register a charge on title. That's it.
You're gonna tell me I can't paint my bathroom blue. Okay, good.
The only requirement reverse mortgage lenders have is that you keep your property taxes up to date. Now, for those who've been accruing, like deferring them, they need them paid up at the closing, but you can defer after again. Yeah, but they need them up to date at closing time.
Probably house insurance. as
Yeah,
well.
those are the basics. And if you're in a strata, same thing, maintain your strata fees, that sort of stuff. That's all they really look at.
Will they ever come and look at the property and say, hey, you need to?
No.
paint the fence?
No, it's no different than your current lender. What they'll do up front is they'll do an appraisal, just like a traditional lender would. And once that appraisal is done, that's it. If you want more funds beyond what they're naturally allowing for with inflationary growth, then they'll want another appraisal. And of course, if, let's say, your property's a hoarder's den or something's wrong, then you may have an issue, right? Other than that, it's just business as usual. Okay. Number two, you can lose your home at any time. As we said, you can remain in your home for life. There are no required monthly payments. And as I mentioned to you before, it's not required to be paid out in full until the last living survivor passes away or both of you wind up in a nursing home. And in that period, they allow up to about 6 months for you to sell the house. And your estate is welcome to sell the house and they can pay the mortgage company out. You can have it still go to a family member who pays the mortgage company out and keeps the house. So whatever, just like any other functioning mortgage. Yeah,
So the minimum age is 55.
correct.
If there's two people on title and one's less than 55,
Can't get a reverse mortgage.
you have to have both people.
Both have to be 55. Yeah, minimum.
Is there a maximum age?
Nope. You could be 105. If you're still around, they'll advance you the money. One last party. That's right.
Very short.
You may not make it there, but you can try. Okay, you'll end up owing more than your house is worth. Reverse mortgage in 3. As we said, they're non-recourse loans, which means that your estate will never owe more than what the net proceeds from the sale are. That's it.
That's amazing.
Oh, it's
But that's like self-insuring. That's like, it doesn't happen. So
It can.
Yeah.
It can in some circumstances, depending on where the property is. So the question is, why would one want to take that risk? Right? It's one of those things that in life you don't get too many guarantees, but
like if it was a mill town and a mill shut down or something like that.
anything can happen to it. I mean, there's like even here, if we look at the peak of the market, which was February of 2022, average values are 15, depending what they are, they're down. So that's a reduction. So if suddenly somebody were to, you needed cash right now, or you had to pay them out, you may be upside down or not upside down, but
Okay.
So that protection is there and really it's for your family members because you don't want to have passed away and then your estate's like your kids are now having to clear off of debt.
But they probably already have built in that 50% cushion anyway.
Oh,
so
they do. It's just one of those things, like, let's say you started at 50 and you've had 40 years of reverse mortgage, interest is accruing, as you can appreciate, it compounds and
Yeah.
it can eat up equity quickly near the end.
Natural disasters, what happens in those?
It's like anything else. There's not anything, like if your property gets hit with a storm or gets wiped out, you have insurance for that. They would replace it, so, yeah. Okay. Mortgages are only for people in financial trouble. That's always a belief that if you are in financial straits, a reverse mortgage is right for you. Now, while that is true, you could have had a bankruptcy. Like I said, what I see more often than not these days is family members helping their grown adult kids who promise to pay the money back, never pay the money back. I'm seeing a lot of that. Or I'm seeing they help them get in and there was a marital breakup of the house that they bought, and now their new spouse wants their share and nobody's paying the parents back. And the parents are stuck making either they gave them cash or they borrowed money against their own property and now they're making payments. So that's one of the advantages of this product is it can solve that problem. Or it could be that, all those things led to a foreclosure, bankruptcy, poor credit, or these days, especially now, qualifying is based on income. The traditional lenders do not lend on equity anymore. So you could have a house worth $1 million, you only want 200 grand, but you make 2,000 a month. You don't qualify, you don't qualify. The bank doesn't give you money. And this is where this product is unique because it'll help them.
It doesn't care how much money you get every month.
Doesn't care about your income, doesn't care about your credit.
Yeah.
Okay? It's got to be reasonable, like it's got to be enough to cover your insurance, your living costs kind of thing. But beyond that, no.
So what happens if there's a bankruptcy during, like, you're taking it out?
Doesn't matter. Once your product is set, it's set.
The receiver could take the house, though, could they?
That gets more complicated whether they sell it or do whatever else. But as people usually typically, that would be resulting with a foreclosure. If they have a lot of equity, would they look at maybe asking them to try to refinance to settle out their debt? It could be, but you may be able to pull enough equity out of there. So those are not more of the situations, more of it is usually upfront. Okay. All right, so let's look at the next one. All right. Your children will inherit debt. We talked about that before, that your children would not because of that non-recourse. Your children are never going to be left owing anything if you were upside down. If there's equity, of course, it goes to the estate and your kids get it. Okay. The other thing I was thinking about this morning, these days, especially now with our federal government's, appetite for getting more money, is with kind of like an inheritance wealth tax or anything else they might want to implement. Obviously a lot of that is based on like the net residual amount of leftover equity from a sale or whatever else, or different things after debts are paid. So it may be a wiser idea these days to try to pull money out in advance of anything major kind of hitting policy, because who knows what the future is going to bring. Okay. And I mean, you have to talk to a tax accountant, get some more advice. But if they implement things like that and you pass away, your house was, mortgage free, you left your kids $1 million, that gets taxed heavily because it's the gain on it, versus let's say the debt was 500 grand. Now there's only 500 to be taxed on and they got use of the money up front. I mean, I don't know. So these days with everything changing, you just don't know. Okay, you must be mortgage free to qualify. We talked about that you can have a mortgage. Whether we'll have enough to cover, it takes me 5 minutes to figure that out, and I can tell you right away. So there's no long process. I don't need a bunch of documents and a bunch of things from you to establish that. In a couple of minutes, we can figure out whether you get enough.
It starts at about 40%, you're 55, let's say, and
Yeah.
it works up if you guys get
Yeah, it can,
older,
yeah,
60, 65, you might go to. Or
yeah, it will be like kind of like 60-ish is kind of the cap, 65 in a real stretch, but you'd have to be like in the 80s.
Yeah.
Yeah.
Okay, so then you're not gonna lend me the amount paid off of my mortgage, you're gonna lend me the value of the property, is that correct?
Yeah, they lend against the appraised value of the property.
Okay.
Yeah. Yeah. So if you owe 200 grand, the property's worth $1 million. If you're eligible for 400,000, you're eligible for 400,000, even if you only have to pay out 200. Okay, is that
so you pay out the 200, you get 200.
200 more? Yeah.
Does that make sense?
No, if you had a mortgage on it, like you were saying, it's not based on the debt you currently have.
Right.
So it's only based on the value of the property,
Okay.
factoring in your age.
Yeah.
And there. That answers it?
You might have missed that part previously. Right, God here was talking about the mortgage needs to be paid off.
Oh,
Like your existing mortgage, we can use these funds to pay out your existing mortgage. The new funds can pay out your current, like, it's no different. Let's say you have a mortgage with TD right now, and I go to CIBC. CIBC gives me money, but they use my money to pay out TD, and then whatever's left over I get.
okay, so you have to get rid of the mortgage.
Your current mortgage would have to go away because you're replacing it with this as a new mortgage company. Yeah. Okay, myth, reverse mortgage interest rates and fees are unreasonably high. Like I said, that's the downside. They're typically 1 to 1.5% higher than traditional mortgage rates. However, your current lender wants you to make payments. These guys don't. You have to decide what that's for. That's just cost
It
of
would
doing.
compound on top of each other.
They will, yeah, they will, yeah, because don't forget, when you're paying down a mortgage, you're decreasing the principal versus here where you're increasing the principal. However, one of the things that is let's pretend that you're currently paying $3,000 a month. Now that $3,000 a month is gone. Well, that's cash flow you're using for something. You have to decide what's that worth. If that now allows you to travel, do the things you wanted to do.
So could you take say you take 200,000?
Yeah.
Could you, and you're just wanting to have that to go traveling?
Yeah.
Could you pay off your interest to keep the interest?
You can,
down?
absolutely. Yeah, they allow you to do that. And you could have a good year where you decide to pay it, and a year where you're like, no, man, it's tough, I don't want to do it. Totally flexible. So it gives you, an opportunity for it not to grow too much.
Cam?
Yeah.
Is, when you're making payments, say you choose to make payments, as
Yeah.
as you were mentioning,
Yeah.
Diane, is like with a traditional mortgage, you can't up your payments just willy-nilly. It's on a set pattern.
Yeah.
So let's say, month 8 comes along and I've had a big windfall,
Mhm.
and rolling in it, and I could take any amount of money to pay down.
So what they'll do is they have certain lenders have certain caps. Some of them have anywhere from 10 to 20% of your original principal. So you can do that. Some of them will allow you just to pay the interest only, which is that. So there's no cap on that portion. You can pay down the full interest for the year.
Okay.
Yeah, you don't have to
But
incur.
you can choose, it's not like biannually or annually.
You could say, look, you know what, it's July, I want to pay down $4,000.
Yeah.
End of story.
Yeah, okay.
That's it. You're not forced to repeat it and continue it.
I win the lottery and I
Mhm.
want to pay off mortgage.
Fantastic.
I do that.
You can.
Okay, just making sure that you're not locked in.
You are in a way, so I'll explain that to you. So each of the lenders has early payment penalties.
Yeah.
Like every other lender out there. So it'll depend. After 5 years, most of them have 3 months interest only, once you've already been in for 5 years. So it would depend on the product that you take. If you take the lifetime lock rate guarantee, they might have a different penalty structure. But they all have something which in time decreases as the longer you go. Because there'd be no advantage to them. You take it out in the first year and pay it out in the first year. They're like, well, what did we do this for? Right?
Yes.
If you win the lottery, 3 months is nothing.
It shouldn't be. Depends how much you win. If you win $25, you might care. Okay. We talked about that you don't have to receive it as a lump sum. There's flexible ways. We can basically structure that to your lifestyle. Quarterly payments, monthly installments, whatever you want. Okay. Poor credit or fixed income disqualifies you. We talked about that. Doesn't disqualify you at all. And then last is they're risky or predatory lending. It's not, because it's regulated. It's not like a guy's knocking on your door saying, hey, you want some money? Doesn't kind of work that way, right? You get what's called ILA, independent legal advice. You walk into a lawyer, he represents you, tells you the documents you're signing, what you're committing to, like anything else. It's very transparent. Okay, does that kind of help? Now, the other thing that happens is if you have older parents, it can even be done with a power of attorney like that. They allow that to happen. However, it's just extra legal to make sure that you're not having elder abuse and somebody's not taking advantage of the family member.
And the parents have to still be living in the home, at least one of them.
At least one of them. Yeah.
So even if you have power of attorney, you couldn't have the parents in care and be renting that property.
It's not for
to be
rental.
sold.
No. And the other thing that you mentioned, that's a good point that we can do. If you have more than one property, let's say you have a property and you have a rental, they will have a discounted value they'll use for the additional property to increase your overall limit. Okay. And a couple of times what we've had people do is they've used it to buy rental property. I've had a couple of people who pulled the money out and used it for the down payment to buy the rental property because they're not debt servicing that down payment.
Right, okay.
So there's lots of creative uses of it if you're going to use it, depending on how you want to use it.
Fantastic.
Yeah. Any other questions? Does that kind of? Is there anything like when you walked in here that you kind of now go, oh, I was wrong about this? Something you believe maybe that, differently about it than you come to learn? No, you guys were all experts, perfect.
Well, I think for me, I've always had a little bit of a negative, towards reverse mortgages, and to have you go through it and explain the upside, I think it really, the upsides overwhelmingly, negate the downsides of it. And I think for anyone that's getting on in years, none of us know how much time we have left.
No.
So it's a wonderful opportunity to live life, instead of living for, 100% for the next generation. Take some of that money that you've accumulated through luck or,
Hard work.
hard work.
Yeah.
And all
And-
those mortgage payments.
And, yeah, just, buy that motorhome you want or
Yeah,
Or-
Buy
it's-
some gas for the motor.
buy
Yeah,
some gas.
well, and I'll,
Diesel.
and I'll tell you the biggest opposition we always hear, that I hear, is from their adult kids.
Yeah,
Cause they're like, hey, they're using up my estate,
right.
my
They
estate.
see their inheritance disappearing kind
Yeah.
of thing, right?
You remember the story I told you about the gal who needed those teeth? She was like 78 years old. She was super embarrassed to go out, couldn't do anything. I got her son phoning and saying, what are you doing? My mom can manage.
Yeah,
It's like, oh, dude, it's like, ooh,
yeah,
and that's where the push is.
That's
So-
elder abuse.
That is, yeah, I called them on. I said, whatever. That's like, it's her house.
yeah.
It's her. It's not, nobody promised you it.
Well,
You're not
maybe they
entitled.
did, though.
Sorry?
You don't know.
No, but her mom didn't. It's not an unwritten rule that your parents have to leave you everything. There's no law out there that says that. It's their choice if they want to do that for you. You should be at least caring enough about your parents that if they're suffering,
Yeah.
you're like, and I said to him, I said, if you think it's too expensive, why don't you give her the money? You could borrow it. You got a house, you lend it.
Yeah.
He didn't want to do that.
Yeah.
So anyway, it happens. And the other side of it that can happen is younger people pushing their parents to go get the money to give to them. So we try really hard to vet all that. That's why the independent legal advice is there, all those different avenues, because you want to make sure nobody's getting taken advantage of. And neither does the reverse mortgage company. They don't want problems.
I think the one thing that stood out for me that I wasn't aware
Yeah.
of is that when people die, the amount that gets paid back is the value of the house, not necessarily the balance of the loan.
If it's lesser, yeah,
Exactly, if the loan is higher than the value of the house at that time,
the lender eats the shortfall.
exactly, that their kids aren't stuck with.
No.
Negative
And
balance.
the kids are free to sell the house, they're free to buy the house, they're free to pay the mortgage out. It's like any other mortgage. The confusion around it is, like I said, all this mythology, this urban legend around it. It's just another mortgage. Yeah.
It really speaks to the home ownership importance of that as early as you can.
Yeah,
Get there, because I work with a lot of older adults in
Yeah.
my work, and there's so many that are renting, and the renter is so high and the
Yeah.
cost of living so high that they're just sinking down a hole, but if they hadn't had that balance.
I always tell people, especially young people that I meet, I said, if you want to be successful, I'll give you one simple rule. If you live by this, you'll be fine. Delayed gratification. So that's it. You live in a world of instant gratification. You want it now. I want this, I want that. Delayed gratification. Hold back, wait, be patient. It'll come. But it's not the culture we live in, right? And that's what allows you to build wealth. Because you will say no to things that you just don't need right away. I remember when I first came to this country, there was no shopping on weekends. So if you saw something on Friday, you had to wait till Monday, and there was no debit cards or no, you had to go like, okay, do I really want this still on Monday? But now it's like 24/7, sit in your underwear and order whatever you want from wherever.
It's a click through.
Exactly. It's like, yeah, and back then we didn't have a word called disposable income. Nobody felt that money was disposable. But that's where we live today. Everything's disposable, right? Thankfully, especially living here, property values have appreciated so much. That's what's built wealth for a lot of people. If they hadn't,
Yeah.
And the sad part is people keep robbing that piggy bank too. But if you've been fiscally responsible, now you're retired, you're on a pension income, maybe your spouse has passed away, you always wanted to go travel to Europe, or I had one lady who took money out, she took her grandkids, her family, and everybody on a cruise. Because she just wanted to do something for them because she's so old now, right? And before she couldn't even walk, she figured like, I better do it now. And it was like $40,000, whatever she did, but it's like she didn't have that kind of money. And she goes, look, I've been responsible all my life. Okay. Any other?
I can have a question. So.
Yeah.
I'm trading my small mortgage for a bigger mortgage, and then the lump sum of money that I get is now being used to pay the bigger mortgage.
No, you'd only be taking the extra money if you want the extra money, if you don't need it. Like if, let's say, for example, you got a house worth $1 million,
Right,
you owe 200 grand.
right.
That's all you have to take. You don't have to take any more. Just pay out that mortgage. It's done. And those payments come to an end. The payments that you were making,
Yeah.
you don't make anymore, so you
Right.
keep that cash.
Right.
The interest that with that 200 grand now has will keep accruing on the current balance that you have, and it'll just grow over time. But you don't have to take more money.
And then, so I don't have to pay it back.
No,
See?
no,
Okay.
no. No, it's only due when
When
you're
I
in
sell
a
the
nur-
house or I die.
or you wind up in a nursing home.
Oh,
Yeah, and 6 months after for that. Yeah, that's it. And if you sell the house, you can port the mortgage to another property. Just like any other mortgage, it can move.
right.
So you could say, hey, I'm now living in here, I've moved to here, I want to continue the mortgage. The only thing they're going to look at is the loan to value. So if you're in $1 million home now and you have, let's say, 200 grand owing, you can't suddenly buy a $200,000 condo and say, I'm going to move my 200 onto that. They'll adjust it. They'll pay down a portion of it to keep the balance based on your age, the percentage the same. Does that kind of make sense? Here, I'll break it this way. Let's say it's $1 million and you owe 200 grand.
Yeah.
That means you've got a 20% loan to value.
Right.
Right? Because now you buy a property worth, let's say, 500 grand. And you want to move the same 200 grand. Now it's 40% loan to value.
Right.
So long as you're eligible for the 40, they'll leave it. But let's say you bought a property now for 200 grand and you owe 200 grand. Well, it's 100% loan to value. They can't do that. Based on your age, they might require you to pay a chunk of it off and leave the rest there. But you already have the money from the sale, so it's no problem. Okay?
Okay.
I think quickly, so it's easy to, so the bottom line question for you is, if you sell it, you can keep the reverse mortgage. There may be some required to be paid down if you buy a property that's considerably less money. That's it. And if you sell it and don't want a reverse mortgage, you're just gonna ride off into the sunset, pay them out, keep your money. End of story.
I have another question.
Yeah.
What if the property that I'm selling isn't entirely my primary residence?
Well, it would be at the start. So if it didn't turn out to be like, how do you mean it not entirely?
I have a character conversion. So
Okay.
there's 4 suites and I live in one.
It's your house.
Yes.
That's fine. Doesn't matter.
Okay.
It's your house. You can have a principal residence with rentals in it. The lender doesn't care.
Okay.
Yeah.
Yeah.
That's totally fine. You're the only one entitled.
I am.
It's your house.
That's another good question.
Yeah. So there is seniors we have who have rental units within their house. Totally fine. They got that cash flow. They got additional cash flow, whatever you want to do.
It's only on the primary residence, your own home.
It's your own, it can't be a standalone rental unless your primary is part of the deal and we're using your secondary for an ancillary borrowing. So you could have, let's say, a duplex that you've got, it's worth $1.2 million with no mortgage on it. You're like, hey, can I borrow a little against this too? Yeah, they will, but they won't give you the same percentage. They'll use a inter alia over both properties. Yeah. They've even done sizes. There's no cap. I know there was one they did in West Van recently for $6 million for a reverse mortgage.
So the other thing is that that money that you get can be proportioned monthly or quarterly or yearly as well. So you could get extra.
If you
payments
pull
to
any
yourself
extra.
If you needed it to, right?
Yeah.
So you don't have to take that 200 cash.
I can just get rid of the mortgage.
That's all she wants to do.
Right?
Yeah.
Yeah,
Yeah.
totally fine.
Or I can get rid of the mortgage payment and go for a cruise around the world.
And
Yeah.
have extra cash
Exactly.
every month if you want.
Right.
Well, she would because she's not making the other mortgage payments and if you want additional, but if you got character conversion with 3 rentals, I'm sure if mortgage payments ended, you're not worrying about it. You got all that extra cash. Yeah.
You're living on a cruise ship. all of a
Exactly.
sudden.
Live the lifestyle that you want. That's what people
Well,
use it
it's
for.
gonna be a workaround, right?
Yeah.
Because I have below market rents.
Yeah.
That's a really tricky situation.
Which is,
right?
yeah.
It's a landlady.
yeah. And so you're capped.
Very few rights. Like, I don't recommend it.
Yeah.
I didn't know what I didn't know.
You know what? But you got a piece of real estate that's probably worth a reasonable dollar.
I
Yeah.
do, and because it was.
Yeah.
I could sign all those rents, then I could do it.
Yeah.
Right, on my own.
Yeah. So totally would be something workable for you. Yeah. Okay, any other questions, any other myths? No, that's it? Have I answered mostly everything?
How long does it take?
Oh, the process? Beginning to start, if you were in a hurry, within 30 days, everything's wrapped up. You got your money. Okay. So no break and push.
Well, in the recording, thanks so much for the
I'll
presentation.
give you guys some cards.
Okay.